From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a blockbuster payrolls report in America, triggering a sell-off in the bond market and giving the Fed the green light to keep hiking. We begin with the big issue, a monster upside surprise.
Wow, stunning, awesome, great for the economy.
I think it's impressive.
Undoubtedly a strong number.
It's a pretty robust number.
The top estimate was 300,000. This is way out of the league.
This is yet again a soft landing type of report.
The onus is on the economic bears.
We're in pretty good shape here in terms of where employment is.
The job growth is averaging, 350,000 or so a month. You cannot discount that.
But I do worry that this challenges the view that Fed Chair said just a couple of days ago, which is that disinflation has started.
The hot, tight labor market is still going to be an issue for the inflation outlook.
For the Fed, it is doubly hard because the last thing it wants to be seen is destroying the labor market to pursue an inflation objective.
Do you have to put another hike, another 25 onto what the Fed does from here?
Joining us now, BlackRock's Marilyn Watson, Krishna Memani of Lafayette College, and Cliff Corso of Advisors Asset Management. Marilyn, let's start with you, and let's start with the market reaction, because we're looking at 16 basis points higher on two-year Treasury yields, the 10-year Treasury yield back to 350. Is this an overreaction?
I think it just really highlights that we're at this point now in the market where we are so incredibly data dependent. And I think we've seen so much volatility continue through after the Fed and after the recent data that we've seen. And then we have these incredible labor market data today. We also had very strong ISM. It's been noted a lot about financial conditions easing, yet we've had a huge amount of rate increases, 4.75 in the space of about a year. And I think we're now at this point where it's really difficult for the market to determine the future path where the economic data is going to go and to really assess where we go from here. So I think it's just really highlighting the uncertainty at the moment. But the fact is that the labor market remains incredibly strong. Inflation is coming down in the US. And so I think now it's going to be very, very much a case of being very data dependent, and the market's really, really begin to scrutinize every single data point that comes out.
And Cliff, along with this big move that we're seeing across the curve, but particularly in the front end, you also saw pricing for the Fed's terminal rate increase slightly. And of course, the conversation around what we got on Wednesday from the Fed was, perhaps we get a pause now. Maybe that's the next move. Do the numbers that we got today push out the pause?
No, I certainly think they absolutely do. You heard all the superlatives. That's a blockbuster number. And I think underneath the hood, what the Fed obviously and the market's very concerned about is wage inflation. It's coming down, but that's the easy part, coming from 9% to 5% inflation. No one should be surprised by that. It's really going from 4% down to 2%. And I think we've got a wage problem. Labor has tremendous leverage. And so I think this good news is maybe bad news because the market's been driven by the hope of a pivot. And this definitely, in our minds anyway, pushes out the pivot.
And Krishna, of course, we hear from Jerome Powell again on Tuesday. And given the data that we got this morning, both in the jobs report and that ISM services figure, does his tone change on Tuesday versus the Jerome Powell that we heard from this past Wednesday?
Well, if you take out the FCI part that everyone is so worked up about, he basically said that their job is not done and they will keep at it until inflation comes down to their target level. So I don't really expect him to say too many things that are going to be materially different than his press conference. I think from the Fed's perspective, the key thing to remember is wage growth is coming down. It's not coming down fast enough. And clearly this print doesn't help their cause that much. But at the end of the day, they are still focused on a soft landing. And I think they may have added another increase or two, but their path is really not changed. He told us, don't expect a pivot. And the market didn't really price it out. So that is going to persist for some time.
And we did hear from Morgan Stanley's Ellen Zentner. She expects the Fed to slam on the brakes. She wrote that, quote, "We think the incoming data and forecast revisions to the March SEP will lead the Fed to pause at its next meeting." And, you know, March feels a long way away at this point, Krishna. But talk about it a little bit. Do we think that the dot plot is going to change in March, and in what direction?
Well, I think looking for a pause in March may be a little too brave at the moment. I think pausing sometime in the first half of this year, I think is quite likely, and probably they will pause and probably keep rates at those levels for a long period of time. The data, the real economic data, is really not soft enough for them to pause this early relative to what they have already told us. So I think the SEP may get revised down a little bit, but not meaningfully so, based on all the things that they have said. And the data that we are seeing today, especially the partial reacceleration in certain parts of the economy.
And you guys already brought it up, and honestly, it's all I've been thinking about. Financial conditions, what they actually mean, what they're pricing in. Powell spoke about financial conditions at his newser on Wednesday. Let's take a listen.
Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. There's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast.
Okay, Marilyn, help me out here, because you look at the Bloomberg measures, you look at Goldman Sachs measures, you even look at the Chicago Fed measures of financial conditions. I see easing there. I don't see too much in the way of meaningful tightening, especially not in the past 6 months or so. So I'm going to come to you. What are financial conditions? What do you look at to judge financial conditions?
Yeah, so I think when you're looking at financial conditions, really it is a very broad-based set of data that you're taking into account. And I think possibly when we heard from Chair Powell, who's talking about a much more narrow measure than that. But essentially, you're looking at a whole range of factors, including where companies can borrow. It includes where the value of stocks and where someone's actually their worth. It's including leverage. It's including a whole range of different factors. And I think they certainly have. When you look at the broad range, so not just the housing market, not just interest rates, but a whole spectrum of things. And I think they have used. And I think you can see some of that even when you look at corporate earnings and the announcements we've heard that they've been sort of so-so, but I think a lot of companies are actually in a good position. And so I think you really want to be looking at households, at corporates, and all the different measures that impact them, rather than just a more narrow set. And so I think it is something that the Fed will definitely be considering. But I think, in terms of the messaging that we heard on Wednesday, they were very clear that they want to sort of stick to the communication. I think I agree with what Krishna mentioned earlier, that they want, they don't want to yet really, highlight that they're going to pause. They want to, be very measured, be data dependent, and really highlight that there's, they'll do as much as it takes still.
And Cliff, to Marilyn's point there, Powell on Wednesday didn't seem all that concerned about financial conditions, but put this into context about what this means for the Fed's inflation fight. Obviously, we went from 9.1% on headline CPI to 6.5%. But then you think about this easing that we've seen in financial conditions. What does it mean for the Fed's trajectory back to 2%?
I think the Fed, although I think you're right, the actual printed announcement coming from the Fed was a little bit more hawkish than it came out in the press conference. But I think it's got to be a little bit irritating, to say the least, to the Fed that every time they tighten rates, financial conditions actually don't get tighter, they get easier. And that's absolutely not the impact that the Fed's trying to have. And when we think about financial conditions, we're thinking about balance sheet and income statement channels. We're thinking about markets. And you can just look, the beginning of this year, obviously the Fed slowed down the amplitude. But if you look at the stock market, way up, you look at rates, the bond market, rally lower in rates. You look at spreads, both high grade and high yield, tighter, very tight actually. This is not the point where the Fed's trying to ease financial conditions. I think that's part of the jawboning that he's trying to get across to the market, particularly with regard to the pivot. I don't think he thinks his next rate hike should wind up being even higher stock markets, tighter bond spreads, and lower rates. That's not what the Fed's trying to accomplish here.
And Marilyn, I want to pivot a little bit because we didn't just get the Fed this week. We got the Bank of England, we got the European Central Bank. And I mean, if you look at the stock market, obviously the rest of the world has really got the U.S. beat. But I want to talk about the bond market here. When you look over the course of 2023, which market do you expect to outperform? Is it the U.S. or is it the European bond market?
So at the moment, I think when you look at where the ECB and the Bank of England are in their cycle compared to the US, then I think certainly the ECB is behind the Fed in terms of its overall cycle, although we do think that they're getting to the stage where they may also look to pause as well. The Bank of England, also obviously raised rates this week, and we expect them to slow from there and possibly be raised again in March and possibly May. But I think when you look at the overall, the stock markets, both in the bond markets in the Eurozone versus the UK versus the US as well, then I think now we really like a lot of the carry that you can get in the US in particular. We've added to our positions there, and we think you get very attractive, very high quality carry, but also in the Eurozone as well. We've added to duration there. In particular, we've added to our positioning in Spain, where we think we get very attractive, very liquid carry as well, given that we think that the ECB will continue to raise, but it is going to, eventually pause pretty soon as well. And then when you look at the UK, and given the poor performance that we saw in the bond market, in the UK in the second half of last year, then we've seen, for example, UK credit has really outperformed in January this year, as we've seen sort of a catch up in that market too. So I think it's a really interesting time as well when you look globally across the different bond markets. And then, of course, you look at Japan, and that's a completely different story again. So we actually really like the diversification, and we like the fact that we can find a lot of different opportunities right now and also take advantage of different relative value trades.
Guys, great conversation so far. Marilyn Watson, Krishna Memani, and Cliff Corso, everyone is sticking with us. Plus, we are going to hear from Chair Powell again on Tuesday. He's going to be speaking to David Rubenstein right here on Bloomberg. Up next, though, it's the auction block. Europe's primary market coming to a standstill after a record January. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe. Issuance coming to a standstill on Thursday after a record January. Sales nearing 300 billion euros for the year. In the U.S., high-grade bond sales totaling $18 billion and seeing monster demand, with most issuers pricing through their guidance range. And the U.S. junk bond market pricing its first deal of the month on Thursday. Unity Group selling $2.6 billion of well-received debt following the busiest month in a year. Sticking with credit, JP Morgan's Bob Michael saying it's not the time for high yield yet. Take a listen.
We've stayed away from high yield because our analysis shows us that the peak in high yield credit spreads always comes during a recession. It could be fast, just like the peak in treasury yields in October happened very quickly, but that's when it happens. So we think high yield is a latter half of 2023 trade.
Still with us, Marilyn Watson, Krishna Memani, and Cliff Corso. And Marilyn, it's an up in quality world. I hear that week after week. Is that your world as well?
Yes, so we still do very much favor quality at the moment. And as you mentioned earlier, given the very tight spreads that we're seeing in the different asset classes within fixed income, not least within fixed high yield as well as investment grade, at the moment, we really are concentrated on the very liquid, high quality carry that we can invest in, and then we can just reap that carry. We do also like some of the carry that we get in securitized, which is high quality. And it's comparable in terms of carry to high yield as well. We do like select names in high yield, and I think now we are very much looking at everything from a bottom-up perspective, and also looking at even on a cross-currency basis where the best opportunities are. But I think for now, just given this environment and where we are and where we discussed in terms of where rates might go now, and the fact that spreads are incredibly tight, then we do really think that we want to just focus on the risks that we understand, the liquidity, and where we can really just get that decent carry.
And Krishna, let's bring you in here because credit's rallied big time this yield, both investment grade and some of those riskier parts of the bond market. How much steam is left in that trade?
Well, I think that is really, at the end of the day, the biggest challenge for the credit markets. That is relative to the risks we face of a potential recession. If the Fed continues to tighten, the spreads are really not that wide. And therefore, it is primarily still very much a carry game. And if the carry game that you're playing, then kind of playing it in the when the base rates are at 5%, playing it in the high yield market, I don't think makes that much sense. You can get decent return in short investment grade corporates, and I think that's where the best values. I want to come back to this FCI issue a little bit because. Okay. The thing to remember is somehow people think that FCI is some metric of economic activity. It isn't. What it does is it correlates well with credit growth, and it's credit growth that we are focused on. And while financial conditions have eased, I don't think credit growth has had the same quantum jump. So that's why the Fed and Jerome Powell feel very confident that they have time on their side, and they're not going to be moved around because equity markets had a 10% rally.
Krishna, I'm glad you took us back there because I wasn't exaggerating when I say it's pretty much all I've been thinking about since Jerome Powell breathed those words. I've gotten in Twitter fights about it. But in any case, one of the components of financial conditions are, of course, credit spreads. And as you bring up, I mean, they really haven't widened that much, certainly not to levels that we've seen in past recessionary periods. And Cliff, I want to come to you on that widening that just isn't there. Does that setup change?
I think it probably does. Our view is that the probability of recession is greater than the probability of not having a recession. And as was said by others here, spreads typically widen and dramatically, not to the levels of, we saw extreme levels in the global financial crisis, but typically you could see high yield spreads, generically speaking, widen to 1,000+ basis points. But, that's the market. And I think the way we're thinking about it, and I agree, we're focused on income generation, and we're focused on building resilient portfolios in an uncertain world. I think there's a place for carefully selected high yield, but really from our perspective, down the front end of the curve. And some of the things we're looking at, we obviously want to avoid highly levered cyclical sectors that can break quicker. But there are a lot of really solid sectors out there in the BB space. Some of them are even upgrade candidates. And you can earn 7 to 8% being careful without a lot of rate risk. Yes, you might have a little spread widening, and you'd have to be able to stomach that. But if it's carefully selected, it's a good real yield, actually, in terms of returns, albeit default rates would be expected to rise.
And of course, an important component of this conversation is the fact that we haven't seen too much in the way of corporate distress, at least when it comes to the default rate. But we got something interesting from JP Morgan earlier this week. They said that credit defaults in January hit the highest since October 2020. Of course, we're only talking about 5 that affected a total of $5.8 billion of bonds and loans. But that comes after the fourth quarter where we saw no defaults at all, Marilyn. So maybe we're seeing the tide turn a little bit. What's your expectation for this year when it comes to the default rate?
Yeah, so I think, well, as Cliff said, I think, if we do see the economy slow down further as we expect it to, and if it were to not be a soft landing, so our soft landing is primarily our base case, but if it were to be worse than that, then you would expect to see the default rate pick up a little bit. I think we haven't seen a lot of activity in that space. We haven't seen a lot of new issues. We're starting to see, as you mentioned, more coming through now. And I think, a lot of companies are in a much better place than they had been in terms of their balance sheets even 3 years ago. But as financial conditions possibly tighten. And as we do see essentially economic data slow down, we're very focused, for example, on, we're very cautious towards consumer-focused sectors and, all the different sectors that could be negatively impacted by, much weaker economic growth or even a recession. So certainly I think, last year was sort of a holding pattern, more, for want of a better phrase. And This year, now that we're seeing such a change in the overall economic environment, change in Fed speaker, change in the bond market for sure, then I think it pays to just be cautious for now.
All right, guys, sit tight for a second. That's Marilyn Watson, Krishna Memani, and Cliff Corso. Everyone sticking with us because still ahead, the final spread. The week ahead, we're going to get another dose of Chairman Powell. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up, we're going to hear from Jerome Powell again on Tuesday, followed by Williams, Cook, Barr, Kashkari, and Waller, all on deck on Wednesday. Then we have another round of initial jobless claims coming on Thursday, and then the Fed speak continues with Waller and Harker on Friday, and we're going to close out the week with the UMich Sentiment Survey. Still with us, though, before we get there, we have Marilyn Watson, Krishna Memani, and Cliff Corso. And guys, it's time for the rapid fire round. We're talking 3 quick questions, 3 quick answers. Marilyn, I'm going to start with you. Does the Fed cut rates in 2023?
No.
Krishna?
No.
Cliff?
No.
All right, we've got a consensus. Question 2, does the U.S. get back to 2% inflation next year, Marilyn?
You mean 2024? Sorry.
Yeah, let's do that. Yeah.
Okay. Potentially by the end of 2024. Yes.
Okay,
yes.
Krishna.
Yes.
Cliff.
No.
Okay, last question. Do we see 3% or 4% first on 10-year Treasury yields, Marilyn?
4%.
Krishna.
4%.
Cliff.
4%.
All right, that sounds pretty bearish to me. My thanks to Marilyn Watson, Krishna Memani, and Cliff Corso. Great discussion, you guys. Appreciate it so much. And as we count down to the end of this week, you're looking at 10-year Treasury yields sitting right around 3.50. Again, maybe we'll get to 4% by the end of this year. And the S&P 500, after initially getting back to positive territory, it's down to the tune of 0.8%. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.